Jonathan Barrett joining us this morning, his Chief Investment Officer, ETO Markets. We're also joined by Edward Yardeni, President at Yardeni Research. Welcome, both of you, and thank you so much for speaking with us this morning. Dr. Yardeni, I'm going to come to you first. Can it get better from here, or should we brace for worse?
I think we should brace for an ongoing crisis, simply because it's all a matter of the Strait of Hormuz. As long as effectively the strait is closed and tankers can't navigate through there back and forth between the suppliers and their customers, the price of oil has the potential for going still higher, which then the longer it lasts, it becomes a stagflationary problem. And already expectations are rising for a recession in the United States and other parts of the world resulting from all this. The president of the United States said that he wants unconditional surrender from Iran. The problem is we continue to behead the government there, and so there's really nobody to negotiate with. And meanwhile, the Revolutionary Guard is kind of running wild, sending drones out to attack their neighbors, to attack whatever ships are in the Persian Gulf. So I think it's not over until it's over.
Meanwhile, crude oil at close to 120 and moving higher very, very rapidly. Jonathan, coming to you next. This is something that nobody would have anticipated. And towards the end of last year, we were talking about the fact that supplies were ample, the OPEC was adjusting flows, all of those things were happening. Talk about things changing rapidly. So how do you react? How do risk assets react in this moment where you could potentially see Brent crude head towards that 150 mark?
Look, I think it's an interesting point that you do raise. We always sort of factored in, like if you think that the Straits of Hormuz, 20% of seaborne oil goes through it, then you could safely say, okay, if something shuts off, then there's 20% in the price of crude oil going up. Now, already we're up at 28% today. So it does look as though it's a little bit overdone. You are correct in terms of the supply. We were looking at more of a glut type of situation. The unemployment number out of the States, in my mind, was bearish. We've had some negative numbers out of China. So the economies are not moving as strongly ahead as what people have thought. So therefore, the price of oil at the moment is a little bit overbaked, but I think rightly so, because we really don't know where it's going to end. The other important thing to think of is, although oil has continued to go on, it's also the natural gas. And natural gas is upwards of something like 70%. And all this sort of contributes to the concern that we have that if we get a sustained conflict, then we're going to get that cost push type of inflationary environment. And I think that's why you've seen equity markets under a lot of pressure. But at the moment, I think given where we are, it's fear that's driving the market, not practicality.
Dr. Yardeni, I saw that you raised the risk of a meltdown in the US markets significantly higher as well in the last 24 hours. The question is this, because this is such an unpredictable situation, if crude were to inch higher, do you reckon Asian markets, which are impacted by crude supplies, and we've had Kospi hit a circuit breaker today and resume trading again, could well have more legs to go on the downside, even if those are irrational prices?
Yeah, I think we're in fast-moving markets here. There's a lot of emotion affecting the markets rather than kind of a cool and calm approach to this crisis. There is a precedent, obviously, for all this, and that's the 1970s when we had two energy crises that led to a decade of stagflation. That led to higher inflation and higher unemployment in the United States. And the stock market basically had a lost decade in the 1970s. So that's where the risks are. And I think the knee-jerk reaction of the markets is to worry that that's where we're heading. I don't think that's the case. I think that the situation will be resolved in a matter of weeks. But that's going to require that the United States and Israel and any other allies that care to join act aggressively against the Revolutionary Guard. The problem is all it takes is one drone hitting one tanker and the markets get all jittery again, go down again when we look at the stock market. So I think it's kind of grin and bear it. I don't think this is going to be the 1970s all over again, but right now I have to say it sure feels like it.
Just on that point, that all it will take is for the US, Israel, and allies that care to join to hit even harder. One would argue they are hitting as hard as they possibly can. Perhaps taken aback by the response which is coming in. And Iran now making GCC nations pay the price.
Yeah, I think what Iran has adopted is a chaos strategy to create as much chaos, not just in its neighborhood, but in the entire world, hoping that the entire world will force some sort of ceasefire in this situation. And that's conceivable. It's the amount of pain being inflicted around the world is intense as a result of the oil and gas problem that's occurring because of the shutting of the strait.
Jonathan, from our perspective here in India, and really I think this is something that everybody is going to be wondering, and we have a graphic that we'll play out later in the show, of course, that talks about the fact that Indian equities have gotten impacted more than certain other countries that are involved in this geopolitical crisis. And so the question is, how do you treat India? Of course, the big impact is going to be on crude oil and the trade balances. But beyond that, the fundamentals were looking pretty decent before the start of March.
Absolutely. And I think the fundamentals are still there for India. One of the biggest problems, if we do look at that 1970s shock, then we do have that concern, that you do have that inflation filtering through. But with India being not self-sufficient, it's oil and a major importer, just like Japan, you're finding that the effects are going to be hurt because we're going to get those inflationary things. I don't think the period of malaise is going to be as long as it did in the 1970s, because that's a trend that things are getting shorter. But I do think the equity markets will be under an enormous amount of pressure as people forecast the fact that we're going to go through this inflationary bout. And I think those countries that are importing, and remember, India sort of imports a lot of natural gas and a lot of oil. So when those combined effects start to reach to the investors and valuations, then it becomes a concern. So I do think that we are in for a little bit of a shock in terms of equity prices over time if the conflict continues. Hopefully it'll resolve itself, but we've still got 3 to 4 weeks of this. And as a result of that, that's going to impinge on the valuations of equities as people focus on much higher interest rates down the track and how that will affect it. But I think there will be a correction, but I think where India is just to buy an opportunity, because we know it has the good fundamentals before, and this will continue over time. But this is an entry opportunity at the right level. The key is working out the right level.
Jonathan, just one quick update. I heard you say in the start, and I think Dr. Yardeni put this into perspective on the equity side, but because you track crude so closely, I heard you at the start say that this seems overdone. Were you referring to the 26% uptick being overdone in crude? Yeah. Or do you believe, and parallelly, could you say that the crude price could actually stay higher because it is about the Strait of Hormuz, and as things stand, it's closed?
Yeah, absolutely. But more importantly, you do have the close, and you do have, but the insurance that's linked to every tanker is now, you can't buy it. Or if you do, it's exceptionally expensive. And whilst those premiums are at those levels, or you can't get insurance, people have to try and ship it some other way, which in itself becomes more costly. This can't turn around in a night. This will take time. And as a result of that, there is that potential for prices to be sustained at these levels up until the insurance market is quite happy to insure ships that actually go through the Straits of Hormuz. That, to me, is probably one of the major reasons as to why the prices could be sustained for a longer than we actually think period.
And Jonathan, for the Brent and WTI, how high do you think those prices can go?
I'd like to see it not to go above 120. I think it's more about resolving and being sustained at a level. Now, as we've seen a 26% rise today, it's very hard to say, well, are we going to expect another 20% on top of that? I would like to think not, but it's certainly possible. I think normally what happens on Monday, the market does get a bit of itself ahead of itself when it waits till Europe and the US comes in. So I think in Asia, we'll probably see the tops. I hope I see the tops for some time, but the thing is that they will be sustained over time.
Dr. Yardeni, do you have a number in mind on how high crude prices can go?
Well, it's very difficult to to model it because it is such a unique situation. We've had energy crises before, but we haven't had a situation where the straits were just closed without any immediate prospect that they'll be opened anytime soon. I know that some people are more expert than I am on the supply and demand situation in oil, have talked about $150 a barrel, and that looked pretty far off at the end of last week, and here we are already up over $120 a barrel. So I think 150 is a reasonable guess, but this is a very suddenly very illiquid market because nobody really knows when the oil will be flowing again.